All right, so welcome everybody. So it's great to see you online. Wish I can see you in person, but this is the best we can do it, and let's take full advantage. So thank you for taking the time to attend this webinar, and we have two wonderful guests from First Eagle and Innovative ETF. So before I start, let me just go over the agenda, okay, of today. Okay, so we're going to talk about the market outlook and investment strategies. Like I said, I got lots of calls about, where to put their money, what do I think, where are we going? There's so many risks, what to do, particularly people who are getting close to retirement. So they're very concerned. So we're going to share about all the interesting things about what's happened to the market, the year-to-date returns and so forth. And then I'll tell you a few interesting strategies that I thought you should look at, okay? And then I'll pass to our guest speakers, Brian from First Eagle. They specialize in the value strategy. So he will talk about how they select funds, how they select investments opportunities, okay? And then Erza from Innovator ETF, they have a very unique investment strategies that will help you limit your downside risk without completely giving up your upside. So participate in the upside, but with a limit and the downside. So that's a pretty interesting strategies, and that's ETF. So you can have good control. It's not like a mutual fund. So anyway, I'm not gonna take the thunder away from Erza. I'll let him present when it's his due time to talk. So without further ado, so let me just jump right in, okay? And then let's talk about what happened to the existing market, current market. So I tabulated what happened, okay? So this is a weekly change, all these negative numbers, so not too great. And then year to date, Dow Jones Industrial Index is down 6.95. That is as of 4/22. But yesterday, I put down the close of yesterday, so it's down even more, minus 7.72. That's Dow Jones Industrial Index. For NASDAQ, it's down 18.31, double digit, and I mean quite a lot. I mean, just talk about just 3-4 months, that's quite a lot. And that's mostly a lot of them are technology stocks. And S&P 500 down 12.22. And then if you want to look at the 10-year treasuries, okay, so because the recession and all that, and we have been really, really pushing down the interest rate. So you can see that it's moving back up. So a year ago, 1.51, this is the 10-year treasury. It's gone up to 2.9, that's 1.39 percentage point, increase year over year. If you think of 2.9, it's really not that high, right? But the jump is definitely, is very visible, and it's affecting a lot of people's buying decision, investment decisions. And then if you look at the gold, okay, that's year over year. And then the crude oil, okay, up 30-something%. So the commodities are doing well. And the investments in terms of NASDAQ, S&P, and Dow Jones, we are not doing so well. Now, I just want to put things in perspective. So let's take a look at this slide. Okay, so, hey, look, do you know that in 2019, S&P return is 31.49%? That is phenomenal, right? And then 2020 is 18.4, and then 2021 is 28.71. And 3-year average is 26%. You can't ask for any more than that. It's absolutely amazing and crazy. Anything over 10% is unreal. Okay, so if you have 26%, 2.5 times the average, it's you can't really complain. So, and then if you look at the average 20-year, this is where you compare. So a 20-year average performance is 9.36. It's not even 10%. And we have been getting these triple, double-digit returns, 2 times the average, 3 times the average norm. So we have been doing super well. Okay, so that's the backdrop that we are facing, we are experiencing. So I wouldn't say that, if you see, the stock market going up this high for 3 years in a row, I mean, just some volatility is really expected. So now I want to talk about the economic environment. So whenever we talk about the economic environment, there's always the positives and the negatives. So let's talk about the negatives first. Ukraine, political tensions. And we all know inflation, what, 8%, whatever, you know, it's keep going up. It's crazy when you go to the grocery stores. Everything is very expensive. And then supply chain difficulties, like how to get the raw material, everything that we need to continue to be productive and producing what we need for the client. So, and then ongoing hiring needs. I know a lot of people, a lot of companies, like the owners, as I think, you know, after COVID, they really rethink, you know, what are their priorities. And some just decide to retire early, or they just demand more from their life and from the company. So there's an ongoing hiring challenge to find the right people to serve and produce the goods that we need as a society. Now, on the positive side, after 2 years, I was hoping when COVID hit, it's only a couple of months or maybe a year, but God, you know, 2 years. But finally, we are seeing that the COVID, the new infection rate is dropping, and then the economy is opening up. You don't really have to wear face masks, depending on where you go. So, I mean, it is relaxing. So that's the positive side. And then the economy remains strong. Because I don't know if you checked your finance, just because you're staying home, I'm saying that, you know, you're eating home, and that's definitely a saving. The restaurants are not doing well, but because you're cooking for yourself and you save on transportation, those are like two pretty big expenses. And that is actually helping a lot of consumers. So what we're going to see, well, I want to show you the numbers later. Consumer savings and the net worth is all-time high. So that's fantastic, right? And because you see the drop in the S&P, NASDAQ, and all that, the valuations was a little bit on the high side because of the sell-off. You know, the valuations are now more like in like acceptable range now. So that's a positive, okay? So let me just show you like actual statistics. All right, consumer net worth has grown. So, okay, before COVID, I mean, sometimes like it's just like, wow, you know, look, okay, we all complain that US people, you're not saving enough, the net worth is not high. And look, just 2 years, the average net worth grew from 120K to 150K. Wow, right? Look, you know, it's like always been like kind of flat. And COVID, wow, you know, I mean, there's like some positive, like some people just got more money because they're not going out and they're saving more. So that's a positive. And then number two, okay, let's take a look. There's a lot of cash at the sidelines because people either worried about the economy, they have additional cash. So look, you know, before COVID, this is not COVID, no, 2020, so it's here, okay? So it's about 3.6 billion. Now it's 4.5 billion. So it went up drastically too. That's a lot of money. So that money can go into investment, that money can go to consumption. So we, as an economy, you know, if you have cash flow, that allows you to do a lot of things. So we are not it's not as dangerous as what the market's reflecting, but because we're at a high point, the volatility is definitely going to be there. And now let's take a look at the S&P earnings estimate. This is 2020, so that's when COVID hit from 162.68, okay? It went down to, earnings per share went down to 138. So 162 down to 138 is quite a drastic drop, right? But then 138, 1 year, it went back to 203, which is even higher than pre-COVID, okay? And then these are the estimates. Of course, these are only estimates. We don't know how we're gonna fare, but look, you know, even if we don't have like a huge jump, so long as we kind of maintain, we are doing then better than COVID before COVID. So from a positive way of looking at it, more money to consumers' pocket, the industry, the business are recovering, and the earnings per share is growing. All right, and then the stock market, I don't have to tell you. All right, so if you were the Fed, what are you going to do? Okay, we got hit with lots of it. The inflation numbers are very high. So what are you going to do? And the interest rate is very low. Maybe this is a good time to shrink my asset portfolio. I've got like $9 trillion in assets in loans, and maybe I should trim that down. And because inflation is so high, maybe I should raise interest rate to help combat inflation. So there's 25 basis point increase in March, and then we expect next week another 50 basis point minimum, and there are talks that maybe 75 basis point. So because I just show you the economy is pretty solid, very strong, earnings, and then savings and cash flow, everything looks pretty good. So if you were the Fed, what would you do, right? Okay, let's raise it. And not only that, they want to raise as fast because they want to control the inflation so the economy can continue on to in a good growth path without being getting too worried about the impact on the inflation. And then this is also, this is the investor sentiments. And then what we're looking at is last week versus historical average. AAII is American Association of Individual Investors. So we are getting bearish. Look, last week only 16.4% investors are bullish, 59% are not are bearish. And compared to historical average, so normally about 38% will remain bullish. So that's like, half of what we normally get. I mean, even lower than that. And then bearish, double, right? So is that good or bad? A lot of times, if it's too bullish, then the crash, when we go down, we might go down harder and faster. So because there are more people taking a more bearish stance, maybe the drop off might not be as severe. Now let's look at the 10-year Treasury yield. That's what people worry about. Okay, the interest rate is going to go higher and higher, higher. But we did start from a very low point. Now this is COVID, 2020 April around here. Okay, that's when we start. We pushed interest rate down to close to 0.6%. So where are we now? Okay, so look at here, it's 2.9%, still not very high, 2.9, right? Inflation is like, wow, 6, 7, 8%. So, I mean, it's not even close to the inflation rate, okay? So, and then the next question people are talking about is inverted yield curve. So that's something a lot of like the financial people will track. So what does inverted yield curve means? And then when you see it, people said that, okay, the very high percentage, this is going to signal a recession. But what does it mean? Normally, if you hold on a loan for a longer term, like 20 years or 30 years, you should get paid more, right? The yield or the return of the 10-year versus the 2-year, you're supposed to get more for the 10-year. But when that reverse, what that means is like if the 2-year is paying more than the 10-year, then something's going to happen and the market is going to crash or something like that. So we have been raising the yield for the Fed fund rate keep going up. So we did observe like just recently that the 2-year yield is higher than the 10-year here. Okay, but it went back up again. So this is a negative. This is 0. So at this point, the yield curve inverted. And then another yield curve, which would be the difference between the 20 and 30-year, same thing. We want to see when it becomes negative. And right here is about the same time, it turned negative. So what does that mean? Does it signal a recession? In the past, it says that every time it happened, almost like 100%, we're going to see a recession. But a better question to ask is not, are you going to see a recession? Is when it's going to hit. So here's an interesting analysis on like when you have a interest rate hike or like a inverted yield curve, when do you expect the recession to hit? So sometimes it's 2 years. So like this study is like 24 months before recession. So you count back. So this gray area is when the recession hit. So 12 months and then 12 months, so 24 months, so 2 years before. So as you see, normally there's a rate hike, right? And then after that, then, soon, because you basically trying to push down the economy, things are getting too expensive and all that. So you will see it drop off and then you hit a recession. And then when that hits, the Fed will drop. When the growth stalls, the Fed normally will lower the interest rate to help push the economy back up again. So in 2000, we noticed that it takes 2 years for the recession to hit. but it can take 4 years too. Okay, so in 2004, 2008, it takes 4 years before you get the recession. Okay, and then in the meantime, the market still continue to grow. So let's say, we know that we're here, okay, and we really, you see why they want to do it. They want to do it fast. They want to compress this instead of going on for 4 years. They want to compress it maybe 1, 2 years or 6 months, and we're back to normal. So that's why they try to really push this fast and quick, because they think the economy is strong enough to take it, and they just want to get rid of all the noise and do it as fast as possible. So when is it gonna happen? We don't know. But these are just like sharing from the past, where we anticipate things, what things to happen. And yes, we will expect contraction in the market, the economy, because the interest rate getting pushed up, and so fast too. So somebody is going to get hit, right? So as far as how the economy react to this, we still have to wait to find out. So the next thing is like, all right, Bonnie, so tell me, so where should I put my money, right? So the next thing, so let's take a look at strategies. All right, so here we go. One way to do it is look at the investments in terms of cyclical and defensive. So what are cyclical sectors? Those are the ones that move the most when there's something hit, like the interest rate or something, or the Ukraine event. So which sectors are that? Those like consumer discretionary. So if I don't need to go to the restaurant, I can cut that out of the hotel. And all those are like consumer discretionary. Energy, financial, all this. Information technology, we know that get hit pretty badly because it's very sensitive to interest rate. And then defensive, okay, those are the services that we will have to pay for regardless, because this is part of our day-to-day expenses. So consumer staples, healthcare, utilities. So one way to look at is that how are these, the sectors that's most affected. I want to, of course, pick the ones that most affected in a good way. And then the defensive one would be, okay, so these are the sectors that will get hit the least, because no matter what happened to the environment, to the financial industry, okay, I still have to go and shop for my food, whatever it is. So let's take a look at how they're faring. So in terms of, instead of look at Dow Jones, instead of taking a look at the Dow Jones, what we're looking at is the different sectors. So energy did very, very well. That's one of our cyclical industry, but that did very, very well. Okay, right? And then what else did well? Utilities. Utilities, that's a defensive sector. So utilities did pretty well. Okay. And then the rest are all like so-so. Okay. At least like if it's negative, it's not like a big negative. Now, with this chart, like we know that the S&P 500 dropped even more than that. This is only first quarter. I mean, when we add on another month, these numbers are even more magnified. But consumer staples is -1%. All right. Healthcare, we always need to see the doctor, whatever everybody is getting old, so we expect this healthcare expense to continue to be part of a day-to-day expenses. So this is another way to look at it. So if you want to just pick the volatile sector, on the positive side would be energy. And then on the defensive side would be utilities. And then the rest is really, you try not to lose too much money, but it's not really giving you a lot of upside too. All right. So this is about the first method, cyclical versus defensive strategies. The next one we look at is value versus growth. Okay, in the past 3-4 years, growth really has take over the lead. We have growth doing so well and value falling behind. People are not even looking at value anymore. But this might be a good time to revisit. Maybe value selling at discount, and growth is selling at a huge market premium. So after a while, it reverts back to the mean. So let's just take a look. This is the dividend index, and this is Dow S&P 500. As you can see, when S&P dropped 4.6%, the dividend or the value index dropped less. And this is a mid cap, okay, a lot less, 4.88 versus minus 1.3. And Russell 2000, which would be even smaller, okay, and the growth versus growth is 2.8% versus this. I mean, as you can see, the green is lower than the purple. So maybe it's a good time to think more. Maybe I should, move back to value instead of growth, okay? Now, the other thing I want to talk about, it's very interesting. So a lot of people want to invest in like the index. So just you buy a little bit of everything and nobody manages, and if it goes up, everything goes up. It's a low cost way of investing. But now, because of what's happening, we talk about value. Is it being overvalued? What is the multiple? What is the earnings per share? All that stuff. So right now, I would actually think that it's probably a good time. You don't want to just buy anything out there. The company that are not making revenue, they're not making money, they're going to be affected a lot more. So let's just take a look at technology. We know that NASDAQ was down 17% or whatever. So a lot of technology stock get hit. However, if I look at it in the decile manner, okay, so the top decile versus the bottom decile, you can see there's a huge range of return. So the top decile is well over 10%. This is decile 1. And the bottom decile is minus 27.9%. So what you want to do is like not just invest in value, you want to invest in quality. As illustrated by this chart, okay, don't just throw out technology. I mean, there are good technology stocks and not so good technology stocks. The difference of the return is like absolutely crazy, absolutely amazing. And if you want positive return, maybe this is one other way of like just streamlining this whole, the by decile, like by quality, and then you might be able to find continuously good performing company because they're bringing in good revenue, they're stable, they have a product that we all want. And then another one, everybody will be asking, so if I want to lower risk, another way is to put my money in fixed income return. Yeah, sure. But, as a matter of fact, like a lot of it is, okay, duration sensitive means term. So the longer the term, let's say if you've been investing 5 years, 10 years, 20 years, it's going to be more affected because like if the Fed is pushing interest rate going up, we saw the negative yield curve. So what you see is that even the fixed income, it's also going to be affected. So this is year-to-date return for April 29th, and long-term government, emerging market bond, intermediate bond, even intermediate bond, it's like which is like 5-7 years duration or term, it's negative. World bond negative, intermediate government negative, multi-sector, so you invest a little bit of like all different kinds of bond, negative. Even short-term government bond is negative. Inflation protected bond also negative. So if you want to be super safe, it's basically you can only like hold cash or floating rate. Floating rate is barely positive. And if you ask yourself whether it can cover inflation, no, we know where inflation is. So it's really difficult to invest. If you want safety, I mean, what is safety? Okay. So this is short term, maybe long term, it's not going to be like that. So I want to remind everyone, after you learn all this, number one, if you really want if you want to be a winner in this type of environment, it will take more thought. We will have to go back and study the sectors, see which sectors are doing well. And then we need to look at the strategy, dividend growth strategy. Okay, and then we want to look at value strategy, but value could still be negative. So we need to dive deeper and then figure out the particular sector and then the decile that's actually giving you positive return. So now it's not as simple as just doing the market index, S&P 500, NASDAQ, because that's not going to give you the return that you want. And if you buying the wrong ones, it can really hit you pretty bad. Why? Because let's go back. We have been doing so well in the last 3 years. No, not this one. Was a return? There was a return, like 20-something% return. You know, I think we'll talk about this. I don't know where's the chart. I can't find it. But I think we talked about that. The return has been fantastic in the last 3 years. Average return is 20%. So we can expect this to continue on. So the last tip, you know, I think you all know, which is to stay invested. If you don't need the money, don't time the market. But if you have extra money, maybe when the market dip, you can buy at the dip. And then for 401k investment, a lot of times it's fixed dollar, like a percentage salary that you're investing. So when the market goes up, okay, so you invest less. But then when the market drops, then you'll be able to buy more because it's cheaper. So that's another way of looking at it. If you stay invested in the long haul, you can see the market always goes up. Yes, we always worried when there's a dip like this, what's going to happen. But the worst thing is you sell the wrong time, which is you sell here and you forgot to buy, you know, jump back in, and then you will miss the upturn. And you can see sometimes it goes up very fast. So anyway, that's basically all that I have to share for today. So I hope you enjoyed all the information that's in this presentation. I think it's time for me to pass to our next speaker. Let me stop sharing. Brian will take over. Oops, so stop share. Okay, so thank you very much. Brian, you take over. Can you?
Yeah. Can you hear me?
Yeah, I can hear you. Can you?
Yep. Yeah. I'll be able to share my screen and everything in a minute, but I got to say I'm pleased that a lot of what you talked about are the exact kind of things that we're working on at First Eagle. And I know we talked a little bit about what we were going to suggest, but like you took the words out of my mouth in some cases about what we kind of want to do. And that's okay, because I'm going to rehash just a couple things and kind of talk about what we do about those things, more particularly about, you know, what First Eagle does. And I'm glad you got a nice partner with the Innovator ETFs with us as well. I think we got some complementary strategies. You know, we talked a lot about, or you talked to, you know, about our presentation being about minimizing risk, but really I think what it's about is minimizing risk in relation to the potential reward you can return, because we're in investments to make money after all. But for us, it does start with minimizing risk. So that I think that's hopefully a good segue to a couple of things I wanted to talk about. And now, like I said, I think I want to preface these comments because our market review, our outlook, we might seem a little gloomy, but it's just like what Bonnie kind of finished up with. You know, there are risks that could hurt the market in the short term, but it's usually best to stay in the market because, you know, long-term equities tend to go up. You saw a slide earlier, it said equities return about 9% on average. So if you can get that type of return, it's worth the risk in a lot of cases. So yes, we're going to talk about risk, but again, I think there's a lot of opportunities to talk about as well, and we'll get there. I just think there might not be the same opportunities as they were in the last 10 years. So to start off, I think it's fair to acknowledge that volatility is certainly back in the markets, and it's both in equities and fixed income, which is somewhat unusual because you've always probably been instructed to have a balanced portfolio, you know, have maybe half in equities, half in fixed income. You'll get a smooth ride that way, but it turns out this year things aren't working out that way. So Bonnie went over the numbers. I'll just highlight them again. Year to date, as of this morning, the S&P 500 is down 11%. The Bloomberg Aggregate Bond Index is down about 8%. That just tracks bonds across the country. Now, I think the question is, what's the primary driver of this negative performance for both bonds and equities? Well, we'd say it's rising interest rates. And Bonnie showed this as well. The 10-year Treasury yield has moved up from about 1.6% to start the year to over 2.8% today. And just as a percentage increase, that's nearly 100%. That's an 85% increase in interest rates. So it's significant. So it's not, you know, 2.8% isn't a huge number in total, but that move up is really what's most significant. Now, why does this hurt fixed income? Why are we seeing bonds down so significantly? The math is pretty simple on it, and it's basically because as interest rates increase, bond prices decrease. So in other words, today's bonds offer more attractive interest rates than yesterday's, so people exit, or they're not as attracted to yesterday's bonds. They want today's bonds with better yields. So you get downward prices in the bond market when interest rates move up. On the equity side, it's a bit more complicated, but really one simple reason rising rates have hurt equities this year is because interest rates have been at historic lows since 2020 at the bottom of the COVID crisis, essentially. Think about this. If interest rates are zero, essentially, it's not very attractive to own bonds because there's very little return potential there. So you're not collecting much income. Now, when bonds aren't a good investment option, when yields are so low, investors typically look to equities because they're willing to accept a little bit more risk to have greater reward potential, to have some reward potential. Now that rates are rising again, and investing in bonds actually grows more attractive when yields are rising, you have investors beginning to exit those riskier equity positions. And as they exit, you see downward pressure on prices. I think another issue driving equity prices down right now is just the fact that what drove the market higher in the last 5 years really stopped working. So you had a small cohort of equities like the names you know, like Facebook, Apple, Amazon, Netflix, Tesla. They were driving the majority of the returns in the S&P 500. And because of that, they became a really big weight as a percentage in the index. So they're a big part of the index. Now that those companies are seeing some negative returns for the first time in a while, it's having really an outsized impact on the overall market. So yeah, that might be painful if you own the broad market or if you have heavy exposure to those companies. But on the other hand, the nice thing is that there are other stocks that are holding up a lot better and have better prospects for returns potentially. So you kind of just have to know what you're looking for. And we'll get into that in a little more detail. I think taking one step back, though, again, is asking about the interest rate question. Why have rates risen recently? It's literally been 40 years that interest rates have gone straight down. So it's been a good time to be in bonds for the last 4 decades. Well, I think the reason for rises in interest rates is what's in the headlines every day. Bonnie talked about this as well. It's that inflation is rising. So it's for a variety of reasons. It's unresolved supply chain issues. It's commodity supply disruptions from the war in Ukraine and other reasons, as well as labor shortages and really ensuing rises in wages at that point. So you have inflation rising at a pace we haven't seen in 40 years. Now, you probably have heard the name Jerome Powell. He's the head of the Federal Reserve, the central bank, Dave Powell. He's got a tough job ahead of him. And if you think about what the Fed is in existence for, they have 2 main purposes. One is to promote maximum employment in the United States, and the other is to have price stability. So it has a lot to do with inflation, of course. And when either objective is failing or falling short, I would say, there are a couple levers they can pull, one being to raise or decrease interest rates. Good news here is that you probably know this as well. Unemployment is currently near an all-time low, 3.6%. So not a lot of work for Jay and his team to do there. But inflation, as you know, has moved up quite a bit. And I'll pull up a chart now since this is something that Bonnie didn't show. Look at for a second on the left-hand side. You have the US CPI, the Consumer Price Index, year over year. So this goes all the way back to 1982, as you can see on the bottom left of this chart, all the way through the end of 2021. You have a rate at 8.5% year over year move up in the US CPI. That is a higher rate than we've ever seen. So longer term, there's some reasons you think this subsides. Like for example, if you look at 10-year inflation expectations, what do the markets think inflation will be over the next 10 years? It's closer to 3%. So it's going to come down at some point, but that number's only been moving up. So until it's really not going to stop until it stops. Is one way to look at it. If you look on the right-hand side, Fed funds rate minus CPI. The Fed funds rate, again, is what the Fed controls. It's short-term borrowing interest. So this is kind of what numbers for CDs are based off of typically. Well, if you take the Fed funds rate that's being offered today, and yeah, it moved up about 25 basis points last month, so we're at like 50 basis points, that's half a percentage point. If you subtract 8.5% inflation from that, you're at a number that is lower than it's ever been at negative 7.8%. So what that's saying is if you invest in CDs right now, yeah, maybe you'll get like a 50 basis point, a half percentage point return, but after inflation, your real return is negative 7.8%. So this is saying that inflation is not really, I mean, it's obviously not a great thing for a lot of different reasons, but for holding cash, essentially you're safely losing purchasing power by holding cash right now. So I think the issue comes to the Fed. And in an ideal world, and let me take a step back, I think, if you have what the Fed wants to do, moving interest rates higher, I think it's pretty simple. If you move rates higher, individuals are less likely to spend money and they're more likely to save money. So instead of borrowing 100K at zero interest rates to add an addition to their house or buy a home in the lake house or whatever it is, they'll save that money because now they can earn a little bit more on their savings instead of spending more to borrow money. So essentially that should cool demand in the economy and it should turn down inflation a little bit. But here's the issue. In that ideal world, the Fed raises interest rates. Maybe you get some volatility like we're seeing now, but the impact on the economy is not so severe and the economy eventually gets back on its path. Inflation cools, everything's cool, everything's hunky-dory. But one of the big fears right now is that the Fed may raise interest rates too high and too quickly, so much so that the economy takes a pretty severe tumble. And that's what Bonnie was showing when they were talking about a 25 basis point hike versus a 50 basis points versus 75, and how quickly they want to ramp up that pace. It could have a negative impact. And unfortunately, it kind of seems like that might be taking place right now, because you might have seen on CNN or in the news, I hope you don't watch the news every day, but if you did see it, it's true that while the Fed has only raised interest rates once this year, they were already speaking about this at the end of last year. And sometimes when they speak, kind of by design, the market moves on what they say before they even do it. So Q1 for the US GDP, the gross domestic product, it actually contracted by 1.5%. So the economy not only slowed down its growth, but it contracted. So it could get revised upwards, but as of right now, the economy is showing some signs of slowing. Now, I think there's always the chance for that perfect landing, but like I suggested, in an ideal world, that's how it would work. Unlikely, or it may be. We see two other potential outcomes. One is, like I said, it's playing out this year. I think down the road you can get back to some slower but positive economic growth, but it's going to take a little while to get there. The other potential outcome is that maybe the Fed cools off and doesn't want to raise interest rates so quickly. The issue with that is maybe inflation really gets out of hand, because like I said, it hasn't stopped until it stops. So like I said, I think we believe it does cool down, but it doesn't have to necessarily. Now, I don't wish to be all doom and gloom, but one thing I do know is that investing really isn't supposed to be easy. It's kind of felt easy in the last couple of years, because even like E-Trade will have commercials. They're like, the stupidest guy in your high school class now has a boat because they made some smart investments. That rubbed me the wrong way, because there's professionals that work in downtown Manhattan at First Eagle that get paid a good amount of money to do some really hard work. And that's why you have consultants like Bonnie that charge a commission for working the way, I should say charge a fee maybe even for working, because it's not always that as easy to make money. And when times are tough, like they might be in the next couple of years, that's when investment professionals really do their best work. And it's when investment opportunities aren't abundantly clear. So with that said, I just want to share a few important and timely investment principles that we employ on our day-to-day. Bonnie hit on a couple of these, thankfully. It's really, first, I think, let's think boring value stocks, not exciting growth stocks. It doesn't mean you have to go completely one way or the other, but in the last 10 years, growth stocks from the new economy and the work from home environment really outpaced that of traditional value stocks, like in financial sectors and energy. A lot simply has to do with those low interest rates favoring companies that have promised earnings down the road. So if you think about it, if you weren't earning anything from bonds today, why not go into companies that have a great chance for earnings in the future? But because of that significant outperformance for growth stocks, they're very expensive compared with their value stock counterparts. Also, as we've discussed with potentially continued rising rates, the profit margins for financial companies widens and their earnings improve. Likewise with commodity prices, so for energy companies, businesses linked to those commodities experience positive growth in earnings as those commodity prices move up. So value stocks are outperforming growth stocks in the last year and year to date. Now, like Bonnie suggested, you can't totally discount growth stocks because for us, if you can find a strong company, a stable business, one that generates cash flow at a good price, as a value investor, we're happy to own them. They're just fewer and further between at that point. I think the second principle would be to think outside of the US. And yeah, I think it's safe to say some of the best companies in the entire world are right here in the United States. But we certainly don't have a monopoly on great businesses. And I think some of the highest quality companies with dominant market shares in their respective industries, you can find them in Europe and Japan. The nice thing is they're at much better prices currently. So really practically thinking, if you're a savvy investor, if you're a savvy shopper, I should say, if you're looking to get the best deal on anything from groceries to clothing or a car or a house, whatever it is, got to keep that mindset when investing, especially now, and expand your horizons outside the US, because oftentimes that's where you find the better deals. Not always, but sometimes. So I'm going to show you one other chart on this real quick, and then I'll wrap up with my last two investment ideas. This is a chart on the left-hand side that shows you the price ratio for growth stocks versus value stocks. If you look at this light blue hash line across the middle, going back 40 plus years, the average price differential is 1.2 for growth stocks relative to value stocks. That means there's a slight premium on average for growth stocks relative to value stocks. But if you follow the solid line all the way to the end, as of the end of last year, December 21, this is showing you that growth stocks were 2.2 times the price of value stocks. That is a higher and wider price disparity than we've ever seen in history. So just to illustrate my point that growth stocks are really expensive right now and value stocks are less expensive, if you're looking for opportunities to keep return potential high but minimize risk, value stocks are a good place to be. Likewise, on the right-hand side, when you look at it's the same chart, just looking at US stocks versus international stocks, the average over time is 1.3%. So that tells you that, or I should say it's 1.3. That just tells you that traditionally there's a premium for US stocks relative to international stocks. But again, following the solid line all the way to the end, December of the end of last year, US stocks were 3.3 times the price of international stocks. So more opportunity in international is what we're saying. Quality first though, buy good companies first and foremost, and that's exactly what First Eagle gets paid to do. Find high quality companies at good prices. I mentioned two last final ideas, thinking about real assets and commodities being one, partly for valuations, partly because of inflation, and partly because of diversification. So real assets like silver, gold, oil, real estate, they haven't performed that well in the last decade. So yeah, again, they're cheap relative to the broad equity market. Inflation's hitting real assets. So having investment exposure there is a great way to protect against high inflation. You move up when inflation moves up. And we talked about that mix of 60-40 stocks to bonds, a balanced portfolio worked so well in the last 40 years, might not work so well in the next 40 years, or next 10 years, I should say at least. So having a balanced portfolio is more difficult, but you can use commodities and even alternatives to kind of diversify away and find other sources of return. That's the final thing, alternatives. And this is specifically to do with fixed income, because like we said, holding cash is generating a negative return after inflation. So thinking about alternatives to traditional bond funds and ETFs even, with interest rates still lower than they were in 2018, there's not a lot of upside potential for bonds right now, even though you get a 2.5% yield. They're more attractive today than yesterday, but still not an attractive risk return proposal by and large. It used to be that the only alternative to your typical bond funds was, guess what? Stock funds. But now I think there are other investments that can give you the volatility and the profile of traditional bonds, but with other benefits. Floating rate, for example, is one. Floating rate loans move up as the Fed moves up their interest rates. So you aren't hurt by rising interest rates when you have a floating rate loan. In addition, with the rise of private credit in the last decade, and also the interval fund structure, I think investors now have the opportunity to get benefits that institutional investors have experienced for several decades. What is private credit though? It's just loans essentially made to companies that are either too big to get financing from commercial banks, or they're too small to access public bond markets. So those are companies called middle market companies. They drive about a third of the US GDP. They're just kind of in this no man's land where they needed some alternative source of financing. That's what First Eagle specializes in as well. Get really attractive terms, better yields, floating rates. So it's an attractive spot to be in fixed income, which is really a land that doesn't have a lot of attractiveness to it top down. So just to summarize all that, it's thinking about boring value stocks, not sexy growth stocks, looking for US opportunity or outside the US for opportunities, looking for real asset exposure, and it's thinking about alternatives to fixed income. And I appreciate you allowing me to speak about this, Bonnie, and thanks for your time.
Brian, do you think you can like give us a summary worksheet on like, the major sectors, so we can share with the people who, yeah.
We have a market dynamics slide deck that I'll show you, and I just didn't want to, in the interest of time.
Yeah, because for people who wants to investigate further, let's give them something. Okay, thank you so much, Brian.
No, thank you.
All right, so
I'm very tempted to let Brian just take all of my time. I feel like I've learned so much in the past 15 minutes or so. So I appreciate that, Brian and Bonnie. Thank you for.
So your volume is like in and out. Can you make it a bit louder?
Oh, really?
It's not, yeah.
All right. Is this any better?
Even louder.
Even louder.
Can hear you.
All right. How's this? Is this?
Oh, better. Yeah,
right
better.
there? Okay.
Yeah, good.
Great. Sorry about that. I don't know what happened there. I just said before I appreciated Brian's talk, and I was tempted to let him take the rest of my time because I feel like I learned so much in the past couple minutes here. So thank you to him, and thank you to you for letting me come and talk, as well as Innovator, the company that I represent, giving us some face time here. I feel like I have the fun job because you and Brian had to talk through all of what's going wrong and what we kind of have to be thinking about, and I just get to present a potential solution. So that's what I'm going to do today. I'll take a couple minutes here and walk you guys through Innovators Defined Outcome ETFs, what they are, and really why we think they're a potential solution for just the market that we're in right now, with all of the nuance and the difficulty and the uniqueness of it. So I'm going to share my screen here. So, like I said, my name is Ezra Lagan. I work for Innovator ETFs, which is a company out in Chicago, and I'm going to walk you through just the who, what, and why of Innovators Defined Outcome ETFs. So, who we are, a little history lesson. We were founded by John Southard and Bruce Bond, who were the co-founders of PowerShares, which was an ETF issuer that got sold in 2006 to Invesco. And so John and Bruce were out of the finance world for a while, and then our co-founder John Southard was being sold a structured annuity, giving him access to an index like the S&P 500, but with a certain amount of downside protection. And he liked that idea, but with a structured note, oftentimes you're locked in for a certain amount of time. There's not a lot of flexibility, liquidity, and also you don't often know exactly what you're invested in. So essentially, he really liked the idea, but he wanted it in an ETF wrapper because ETFs is what he knew, and they're a lot better of a wrapper in his opinion. So that was kind of the idea behind our defined outcome ETFs. We now have, as of March 24th, we have just over 6.7 billion in AUM. And we only launched our first fund in 2018. So it's been a lot of growth in the past couple of years. Unfortunately for all of us, as the market declines, sometimes our product looks better because it's a potential solution. And so people want to have this conversation. They're looking for alternatives, as Brian suggested. So that's kind of a little bit of the history around Innovator, who we are. Our basic product lineup, our bread and butter product, this buffered ETF, essentially offers you a downside buffer of 9, 15, or 30%, and then upside exposure to a certain index. So let's take a look at this first one, this 9% buffer, for example. A buffer, all it means is you're protected up to that amount. So you own the S&P if you buy this ETF. So all of the upside of the S&P 500, you participate in up to a cap. And then on the downside, let's say over the course of a year, the S&P goes down 15%, you're protected for the first 9%. So you'd only be on the hook for 6%. All of these ETFs work the same way. So this 15% buffer, same thing. You're protected for the first 15%, and then you're participating on the upside to a certain cap. The indexes that are available with the 15% buffer are the S&P 500, MSCI EFA, MSCI Emerging Markets, the Russell 2000, and the NASDAQ 100. So the benefit of using the 15% buffer is we have a more robust lineup. You can explore some of those other markets. Again, as Brian was suggesting, you can look overseas and maybe be invested in some of the companies that are in the emerging markets index, but you still have the benefit of that 15% of protection on the downside. The 30% buffer is a little bit unique, simply because it's a -5 to -35% protection, meaning for the first 5%, you are on the hook. And then anything past that from 35%, you're protected. So it's more like catastrophic protection. If you think, we're heading into a recession in the next couple of weeks, next couple of months, and you want to make sure that you are protected for that 35%, this would be the ETF for you. A couple of the key benefits using an ETF versus a note, and this is what our co-founder, John Southard, realized as he was being sold that structured note back in 2017, right before we started, was ETFs allow for tax efficiency. They're intraday liquid. They're transparent. You know what you're investing in with these. It's these 5 indexes. Their ease of access. As an advisor, there's less paperwork. As a client, there's less paperwork. It's just everyone knows how to buy and sell an ETF. It's not a complicated investment product considering how long it's been around. They're low cost, especially in comparison to structured notes and other annuities. So these ETFs all have an expense ratio of 79 basis points. And then there's no credit risk with these either. That's one of the benefits of the structure that we use, is that with these ETFs, let's say Innovator were to go under, the underlying mechanics is just 4 options positions. They're options purchased on these indexes. And those options give you the upside exposure and they give you the protection on the downside. And you, as the end user, actually own those options. So let's say Innovator goes under tomorrow and you own one of our 15% buffers. What you're left with is just those 4 options positions packaged in an ETF, and you just sell those right back to the market, and you'll get your money back. And you don't stand to lose anything in like a 2008 crisis. When some of those notes and more risky investments that were just on a bank's balance sheet defaulted. So a couple benefits of the ETF wrapper there. And in a more practical way here, I want to walk through how these would look in different market environments. So you have this situation, let's say the market goes to 0, it's like an Armageddon type situation. This is just showing you what you would experience with these ETFs. Market is this yellow line here, or your reference asset is another term for the index that you're tracking. So let's say you bought a 15% buffer on the S&P 500. The reference asset is in the S&P 500. So you're watching what that'll do to determine what the value of your ETF is going to be. So S&P goes down to 0. You have that 9% buffer. You're only on the hook for 91%, 15% buffer, 85%. And then that 30% buffer, 70%. This is not great for anyone. It doesn't look great for a product. It doesn't look great for the general market, because again, this is in the absolute worst scenario. Let's think of a major sell-off over the course of a year. You have a 30% decline in the reference asset. That 9% buffer, you'd only be on the hook for 21%. That 15% buffer, you're only on the hook for 15%. And then that 30% buffer, you're only on the hook for the first 5%. So I think you can see where I'm going with this. This is just showing you how the buffers perform. If it's in a down market, you're protected up to the amount of your buffer. In an up market, like I said, you're going to participate in the growth, but up to your cap. So let's say the S&P 500, your reference asset, goes up 7% over the course of holding your ETF. All of these ETFs are going to give you that 7% of upside growth as long as it's underneath the cap. In a situation of high growth where the S&P 500 is doing really, really well, these ETFs will probably outperform. And that's why we usually talk about these as a trade-off. Because you have that protection on the downside, you're not going to be allowed to participate on all of the upside. And it's just a simple trade-off. You know, are you happy with whatever the cap ends up being? Let's say it's 15% on that 9% buffer, like it is in this example here. So you participated in 15%, your fund returned 15%, and you had the peace of mind in knowing that if the market returned and went down, you still had that 9% buffer. So 15, 10, and 7 for that 9, 15, and 30% buffer. Now, getting into a little bit more of the specifics of what you'd experience using one of these, I pulled up an example of how one of these ETFs performed over the course of its outcome period. So all of these 9, 15, and 30% buffers are structured for 1 year. So you can see this was the 15% buffer that we launched in April. So its outcome period was 1 year from April 1st of 2019 to March 31st of 2020. On April 1st of 2020, this started a new outcome period, and every outcome period you have your 15% buffer and your certain upside cap. And so it's a simple way to look at it. Year over year, from the first of the month that you buy it, you have a certain downside buffer, 9, 15, or 30%, and a certain upside cap. Now for this ETF, you can see from April 1st of 2019 to March 31st of 2020, that was the COVID sell-off, right? So our underlying index was the S&P 500. You can see that here. That's that light blue line. And then the fund itself is the dark blue line. So it's tracking along directionally with the underlying index. You experience a little bit of a lag throughout your interim period. That's one of the benefits of these ETFs is you essentially, until the end of your outcome period, have low volatility. So you're experiencing a little bit less of the ups and a little bit less of the downs relative to the underlying index. And then at the end of the outcome period, you're going to start truing up, essentially. It's like a bond. You're going to go back up to par depending on what the market is doing. So here, the underlying index, the S&P 500, was down 8% on the year. And you can see that, right? It's the light blue line. And our ETF ticked right back up to its starting point. It did exactly what it was supposed to do. The buffer kicked in, and you ended your outcome period right below your starting point. The only reason you're not exactly at your starting point is because you paid that 79 basis point expense ratio. If you want actual numbers, you can see here. So the current outcome period values, that's what the ETF ended at. So it ended at a price of $24.02. It returned negative 73 basis points, which was our expense ratio. And then that was relative to the underlying index, which returned negative 881. And that's relative to its starting point. So the outcome period values when it started was $24.94. And then obviously 0 and 0 because the outcome period hadn't started yet. So just in really simple terms, at the start of every month, we have a monthly offering of our 9, 15, and 30% buffers. They go from the first of the month to the first of the month of the next year. And over the course of that year, you have a certain downside buffer. You choose 9, 15, 30%, and then a certain upside cap. That upside cap changes depending on what's going on in the market. The more volatile the market, the higher the caps. So our May series starts its new outcome period tomorrow, or not tomorrow, May 1st. So it actually start over the weekend. But that has a cap, the 9% buffer has a cap of around 18%. We're expecting a cap of around 18% because of how volatile the market has been. So I'll move on here. So that's our buffered ETF. Just a quick, pitch. We have other products available on our website. Innovator ETFs was created to help the end user, the investor, find ways to combat volatility, combat interest rate risk, just find ways to outperform in periods of market instability. So we have other products available. I'm not going to go into all of these for the sake of time, but love to have a conversation with any of you if they're interested. Our accelerated ETFs, instead of a buffer, they give you 2 times whatever the index does up to a cap. Laddered funds are a simpler way to get this exposure. So we're constantly innovating. We're constantly thinking of new ETFs that would allow you to flexibly stay invested in the market, but with protection or outperformance. These are a couple of the benefits of using these ETFs. The buffered ETFs allow you to stay invested in the market, but with that protection. That's important for things like with cash sitting on the sidelines. You don't want that cash to get eaten by inflation. Like Brian pointed out to us, if you have cash sitting on the sideline, the only thing you're guaranteed is that it's losing its purchasing power. So let it be put back into the market, but with that some level of protection, so you don't have to worry about it as much. And then the benefit of the ETF wrapper is if you determine that you need that cash for an expense, it's intraday liquid. You can sell it at any point. This is a low vol alternative. Like I said, you experience low volatility in the interim period before the end of your outcome period. Potential class alternative. It's an equity replacement if you want to get invested in other, emerging markets, companies overseas, but you don't want all of the volatility that could come with that. Replace some of your straight up equity positions with some of these buffered positions. It's a potential bond alternative, especially with where rates are at and where they're expected to go. You could be losing more money in bonds than you would be in an equity replacement, especially if there's a hedge on it. And then obviously an indexed annuity or structured note alternative, a lot simpler of a wrapper, a lot cheaper of a wrapper, and a potential alternative there. So thank you for, giving me a second here to walk you guys through this. I hope this makes sense. Our contact info is there on the screen. Happy to have a conversation with any of you guys, and we work with Bonnie. So Bonnie, if you have any questions or want to talk through stuff, obviously happy to do that. Really appreciate you giving me some time to walk through this today.
Thank you very much. Thank you. I think today we have some really interesting sharing from strategy, from market review, and then a few pretty innovative ideas, how to minimize risk without giving up the upside. And then I think Brian also talked about a few other strategies in, basically identifying where the risk and reward and how to take advantage of the current market on certain sectors that will produce value, but has been neglected in the past couple of years. So I think that's all we have to share. I'm sure people have questions, and we welcome questions. I don't know if any people wants to ask. I mean, I know it's already past the hour, so whoever needs to go, don't worry about that. Everything will be recorded, and I will send it out to those people who registered. And if you have other questions, please feel free to reach out to either me, Brian, or Ezra. Okay. Any questions? All right. That's great then. Okay. Thank you for attending. All right. I'll send everybody the recording. Thank you. Bye-bye.
Thanks, Bonnie. Have a good weekend.
Thank you.
Thanks, Bonnie. Happy weekend.
Thank you. Thank you.